What's up everybody, my name is Tom from Control Your Wealth and welcome. In this video I'm going to break down two ETFs and why you can buy and hold these forever. But before we start, make sure to like this video and leave a comment, which helps this channel tremendously. Now let's get into it. The combination of these two ETFs was inspired by Warren Buffett's legendary 90-10 investing strategy for the investments of retirement savings. In Warren Buffett's 2013 letter to Berkshire Hathaway investors, Buffett noted that upon his passing, the trustee of his wife's inheritance was instructed to put 90% of her money into a very low-fee stock index fund and 10% into short-term government bonds. The larger point he was trying to make was about the makeup of the portfolios, which is investing in low-cost, low-turnover index funds, and not the precise allocation. Following this method, Buffett believes that the potential gains an individual investor could achieve will be superior compared to those investors who employ high-fee investment managers, or in other words, stock pickers. An interesting admission for someone who's made a fortune picking stocks himself. Warren Buffett recommends a low-cost ETF that benchmarks the S&P 500. The low-cost feature of such funds will prevent fees from eating into returns. The idea is that the S&P 500 will always generate returns over the long term, and generally it is tough to beat the market. But if a 90% stock allocation seems too much for you, pulling back a little might not be such a bad idea. The ideal allocation will depend on the investor's age, risk tolerance, and financial goals. These two ETFs are already part of my investment portfolio, and I'll show you why they work very well for this type of structure. However, it's important to keep in mind that these are not the only ETFs out there, so be sure to do your own research before making any investment decision. So, let's start with the first ETF, VOO, the Vanguard S&P 500 ETF. As the name suggests, this ETF tracks the performance of the S&P 500 index. In other words, VOO invests in 500 large companies listed on the US stock market. These companies include big names like Apple, Microsoft, Amazon, Tesla, and even Warren Buffett's own firm, Berkshire Hathaway. So why VOO? Well, for starters, the S&P 500 is widely considered as a benchmark index for the US stock market. By investing in VOO, you get exposure to a diversified portfolio of blue-chip companies, which makes it an ideal choice for long-term investors who want to grow their wealth over time. Another benefit of investing in VOO is its low expense ratio. Vanguard, the company that manages VOO, is known for its low-cost index funds and ETFs. In fact, VOO has an expense ratio of just 0.03%, which means you'll pay only 30 cents for every $1,000 you invest in the fund. VOO is also a passive fund, which means that the fund's portfolio is not actively managed by a team of analysts and portfolio managers. Instead, VOO is simply tracking the performance of the S&P 500 index, which is exactly what we are looking for. Historically, VOO has also performed really well. In the last 30 years, VOO obtained a 9.74% compound annual return, and in 2022, the ETF had a 1.37% dividend yield. So overall, this is a great ETF to get exposure to the S&P 500. The second ETF in this portfolio is the Vanguard Short-Term Treasury ETF, or VGSH. This ETF is designed to provide investors exposure to short-term US Treasury bonds. Treasury bonds, also known as T-bonds, are issued by the US government as a way to borrow money. So when you buy a T-bond, you're essentially loaning money to the US government. And in return, the government promises to pay you back the amount you loaned, plus some interest. T-bonds are considered a very safe investment because the US government has never defaulted on its debt. This means that you can be relatively certain that you will receive your money back when the bond matures. VGSH invests in a portfolio of treasury bonds with a short-term to intermediate-term maturity. This means that the bonds held in the fund typically have a maturity of 1 to 3 years. The fund aims to provide a low-risk investment option for those seeking to preserve capital and earn a modest return. As treasury bonds are considered to be among the safest fixed income investments, VGSH is often used as a safe haven during times of market volatility. This fund also has a low expense ratio of just 0.04%, making it a cost-effective way to access the short-term treasury market. In the last 10 years, VGSH obtained a 0.67% compound annual return. But the annual return is not the reason you hold this in your portfolio. It's for the price stability of the asset and the interest it pays out. Due to the rising interest rates, it currently has a 4.63% yield, which is relatively high in comparison to recent years, which makes it an opportune time to invest in this ETF, while also lowering the risk of your overall portfolio. So, there you have it, 2 ETFs that you can buy and hold forever. It's up to you to decide on the exact allocation. You can go with Warren Buffett's 90-10 structure, or increase the treasury bonds allocation if you want to reduce your risk. You can even decide to just invest in VOO and remove the bonds allocation completely. It all depends on your personal situation and risk tolerance. Thank you so much for watching, and don't forget to leave a like and let me know what you think of this portfolio structure and these ETFs in the comments. If you want to learn more about building wealth and investing, be sure to subscribe.